Yeah, good morning. Good afternoon, everybody. Welcome to this interactive session or interaction with media friends. On behalf of Emkay Wealth Management, welcome all of you. Uh, this is our okay. This is our eighth year in operations in terms of wealth management business for MK Global. Um, we are now about a 50-member wealth manager strong team across about 13 locations. Right. We manage close to about 17,000 crores of assets under our distribution, so to say. Uh, at MK Global, we are extremely excited about the prospects and the growth prospects of wealth management industry in India per se. If you can see the slide, clearly suggests a significant wealth boom. Consistently in the past 10 to 15 years, continuing in 2024, 2025. In 2024 alone, we as a nation added close to about 33,000 new millionaires in a single year. This is according to a World Wealth Report. The number of high net worth individuals in India rose by almost 5.6%, bringing the total to about 378,000 from about 345,000 in 2023. So it's a consistently growing segment in India. But again, if you break them down into different segments of high net worth individual, you will get to see a far clearer picture. So the total wealth that we manage, the rise that we have seen is close to about 1.5 trillion, marking India as one of the fastest growing wealth hubs globally, outpacing major economies, including China. Most of India's new millionaires fall under a category of millionaires next door. What it really means is the category is between 1 million to 5 million. And in India, we've had a clear growth of about, now it's standing about 3.33 lakhs of such individuals by end of 2024, controlling close to about $630 billion in wealth. On the top end of the pyramid, which is the cream de la cream clientele of Indian country, which is called ultra wealthy clients. The India now is home to close to about 403 ultra HNIs, defining them as those having more than 30 million in investable assets or investable surplus. Their collective wealth has now reached $435 billion in 2024. So that's the opportunity that we are looking at. I think Indian billionaires or millionaires are consistently growing upwards of 8 to 9%. And MK is quite well placed in terms of taking a good pie of this, taking a good share of this pie going forward as well. Traditionally, so this is the current, stack up of Indians' wealth across different asset classes. The cash, the equivalent, the gold continues to dominate with 28% of, our household incomes, getting there. But having said, equities is now catching up with, with the traditional assets. Real estate is stagnant, so to say, or I would say, coming down a little bit. So real estate is at about 19%, equity is about 22%, alternate assets and fixed income is at 14 and 18%. So that's the wealth distribution that we have seen. India, once upon a time, was a huge on cash and equivalent and real estate, which is now getting well diversified across asset classes. So it's clearly is a sign of market maturing faster than expected. What's really driving the growth or driving the business across the asset classes within the wealth management spectrum is the equity market surge. While last one and a half year has been subdued, but in the same period, India saw the exchange rising by 8% upwards, pushing the values of portfolios of customers a little higher, right? India's story continues to be intact in terms of domestic consumption, entrepreneurship. We all are going through a rapid digitization, a booming startup culture, and sectoral diversification, especially in tech, fintech, and infrastructure. And we've it is also fueled with the individual wealth creation. So there are many ultra HNI customers who are now ready to look at investments in the startup. So start investing into unlisted space or investing into such kinds of ventures has also become an integral part of ultra HNI customers' portfolio. Uh, Very interesting data point, which is inheritance wave. So what we have as an as a generation since the liberalization, the wealth that has got created in India will eventually get passed on to the next generation and will have an unlocking value of it, right? Which will have close to about 50% of it will get inherited by 2030, and it will continue to grow, beyond 2030 to about 2040, and the numbers will continue to grow. So what is really happening is the wealth which got created by virtue of India getting liberalized, India growing faster, economy growing, from a million to a billion to trillion to now $4 trillion. The wealth which got created will have an unlocking value going forward, at least in the next 15 to 20 years. So that's a huge, opportunity that we all are sitting on. And that is where we as financial advisors are looking at looking at it as a great opportunity. And we are seeing more interest in offshore investments, trust structures. These are some of the trust structures, will writing, family, trust and so on. So family structures are, taking an important aspect in the portfolio discussions at the family level. Interestingly, the most of the growth that has happened in the last 2.5 decade has been attributed to metro cities, but I think the equal amount of enthusiasm and pivotal change is also happening in tier 2 and tier 3 cities. And that's where, if you go to tier 2, tier 3 cities, you will see a huge amount of enthusiasm, huge amount of uptick in the wealth creation story as well. And that's why, I believe financial services industry will also have its second level of boom from tier 2, tier 3 cities, right? So digital online platforms continue to dominate, certain section of advisory, right? And that is also catching up on a lot of Gen Z and Gen X, attributing or moving their investments to digital and online platform. Uh, so as we have been seeing, mutual fund industries AUM, growing consistently in the range of 20-25% YOY. Similarly, we are also seeing the PMS and AIF industry also growing faster than the last decade. So this decade, or at least last 5 years, has been phenomenal for the growth of PMS and AIF industry. The numbers are there on your screen. So while mutual fund industry grew by 25%, for the past 5 years, overall PMS industry is also seeing a clear growth of about 26% in the last 5 years. So is growth in the AIF, to the tune of 29%, right? So over the LRS investment is also growing, quite fast. So equity and debt investment by resident Indians via LRS were about 1.5 million. It has now risen to about 1.7 billion in FY25. With more than 5,000 managed products, the wealth managers, of course, it's needless to say, wealth managers remain, relevant primarily because everything cannot be DIY, for offshore, for many other investment solutions. Financial managers, wealth managers remain the important cog in the entire wheel of customers' portfolio management. So this is the founding team of wealth management business for Emkay Global. On the left-hand side, you have me. I look after the sales and service part of wealth management business. We have Ashish Ranade, who's up next to take you through the equity side of the discussion. He heads the products. We have Dr. Joseph Thomas, who heads the research and advisory for our high net worth individuals. And we have Ashish Todi, who heads the strategy and new initiative aspect of our business. So this is the 4-pillar founding team of wealth management business for Emkay Global. This is how we are currently present across India. There are two locations that we've recently added. Hopefully, in the next interaction with you guys, we will show those two locations. And like I was mentioning in the slide two slides below before, that we are also aggressively and excitingly looking at tier two cities. So we've recently uh, entered into Ranchi market. We have opened an office in Ranchi. We have opened an office in Baroda. We are also ramping up a team in Baroda as well. And there are multiple, few more cities that we are discussing with the partners and trying to increase businesses there. Won't be able to tell you the names, but as and when they get added into our arsenal, we will inform you in the next round of interaction. So currently, we are present in 13 cities. So that's from my side. That's a brief introduction about the journey of last 7 years of MK Wealth Management on MK Global Financial Services platform. How we are, what is our outlook on the prospects and the opportunity of wealth management industry in India by way of, by corroborating them with some facts that we have shown you. We believe, wealth management industry is just scratching the surface. There is a huge potential, and we will like to be a, relevant partner in this growth of wealth management business in India. With that, I'll take a pause here and hand it over back to Amit for him to take it forward. Thank you very much for your time. Thank you.
Thanks, Parag. I'm Ashish Ranawade. I head products, and I'll briefly take you through the economic environment that we are currently operating in. We are largely, in a era which has not been seen before. If you recollect the last 20 years, and there was a very famous book which was called The World is Flat, where you had uh, economic boundaries coming down, and nations which were good at producing what they were best at, doing the things which they did, and then there was a large scale integration which was happening in the world, because of which China became the manufacturing hub for the world, India became the IT hub for the world. And that's how the world was growing. But suddenly, this year has been I would say, a very important milestone in that journey of globalization, which seems to have been terminated um, because of one man who seems to, be hell-bent on causing a massive disruption across the world. And you know, US being one of the largest market, the consuming market in the world, imposing tariffs across all countries has created a massive disruption in terms of supply chains. And we just saw how, the auto industry in the US has been impacted because of the tariffs which they have imposed on Mexico and Canada. I believe, to manufacture a simple automobile or assemble a simple automobile in the US, the parts used to go across the border, or they used to cross the border at least 5 to 6 times between Canada and Mexico. Now, when you impose tariffs, there is going to be a big disruption. And this is not just the neighbors, this is happening across. And India has borne the brunt of it with the highest tariffs of 50% being imposed. Uh, Along with this, the wars which have been going on between Ukraine, Russia, and there's polarization, significant polarization, which is happening because of that one war. And also in the Middle East, significant amount of polarization. Countries are being, forced to take sides. And that has also caused a massive disruption in terms of, the smooth supply lines and the smooth trade flows which were happening or which were building up over the last 20 years. And I think this is something which is unprecedented. People say disruptions are good, And we've seen product disruptions, we've seen industry disruptions, but this is probably the first time in the world where we are seeing a disruption on a global scale. How are we going to navigate this? How is the world going to navigate this is a very pertinent question, because we've not seen anything like this before. And unlikely that the US seems to be backing down on what they have set themselves upon. In the light of this, I would say IMF has been brave enough to say that the impact on the global growth. Next slide, Amit. Would not be so much. It's only about 0.5 percentage at the global level in the calendar year 2025. Now, this is largely because China has been doing decently well because of its large domestic economy. India has been doing well because of its large domestic economy. The Middle East, Saudi Arabia, and some of these countries, have been doing well. But then, nevertheless, a 0.5% impact on global growth in calendar year 25 is bound to impact, a whole lot of projections or performance of a whole lot of countries and of companies. Thankfully, in all of this, as I mentioned, because of a vibrant domestic economy, India is expected to do between 6.2 and 6.3% in calendar year 25 and 26. Yes, this growth could have been higher if we would not have been imposed by the highest tariffs. But I think there are three things which are going very strongly for the Indian economy. Number one, the budget this year has been good. The government has put in some money in the hands of the consumers. The GST cut has been good. Again, goods have become a little cheaper, so that increases the volumes of a whole lot of products. And the third thing, which is again a global phenomenon, but with interest rates likely to trend down, there is a good chance of us doing better than what is expected, at least in the short term. So if you look at the growth post FY22, we've been trending between 6.5 and 8.5, but could have been better. But I think we should not have anything to complain. This year, we've had one of the best monsoons. The water stock has been much better, and which points in the direction of the second half, which is the busy season or the festive season, being better than what we have seen in the first half of this financial year. The manufacturing and services PMI, which is an indicator of how well the Indian economy is doing. In August, we hit a 15 or a 17-year high in terms of the manufacturing PMI and the services PMI. So I think we were that again explains the resilience of the Indian economy, and the fact that there are macro factors which are going well in our favor. So I'll call upon Dr. Joseph Thomas to delve more into these specific factors on the domestic front, and then we will get onto what's the view on the markets and what kind of products investors should look at. Dr. Thomas, over to you.
Thanks, Ashish. Thank you very much, and welcome, dear friends from the fourth estate, to this brief presentation. And coming to the broad domestic macros, we know that the last quarter GDP growth rate was 7.8%, and the likely decline in GDP growth on account of the tariffs and the adverse international environment would be something like 0.5%. So if we build that 0.5% fall in the GDP growth into the last quarter's GDP growth of 7.8%, we moved closer to around 7%. And many international agencies, mainly market players and all that, have forecast the GDP growth for India for the current year to be closer to around 6.7 to 6.8%. Indian economy is structurally tuned to grow at 7%, with 0.5% this way or that way is the kind of growth that we could expect from the economy. As of today, the government finances are in very good shape. The fiscal glide path has been maintained, and the government borrowing program remains at the same level, which was actually as per the union budget. The borrowing program for the second half is more at the longer end of the curve rather than the short end of the curve, but the borrowing program remains the same, and there is no likelihood of the government borrowing program moving up. If at all there is a revenue loss on account of the GST cut, it's going to be a very short-term revenue loss, and it will be more than made good by money which could come into the government's coffers through other sources also, including a generous dividend from the RBI. The expenditure multiplier, can you move back to the expenditure multiplier will take care of the revenue growth in the coming 2 to 3 years. Because if there is a give up of 1 lakh crores in terms of revenues, the push that it will give to the expenditure would be something to the tune of about 3 to 4 lakh crores. And the public capex, which is very critical to the economy and the businesses, it has been quite critical and supportive of the economy. In the last 2 financial years, continues to be at 11 lakh crores, and it will continue to support the economy. Next slide, please. On the RBI policy, RBI had shifted the stance from accommodative to neutral, and RBI continues to be in a neutral mode, and RBI is likely to change policy only in case of any serious threats to the growth story that's going to emerge. So as of today, it is only the 0.5% decline that's expected on account of the tariff issues and the related impact on external trade. Otherwise, there are no major threats to growth as such at this point of time. Inflationary pressures are very, very low, either from food or fuel. It is quite low. Fuel prices remain more or less stationary at the current levels. Even in international markets, the oil prices remain more or less at the same levels. Seasonality in food prices could crop up once in a while, but that won't be a major threat to the price level as such. So RBI is still watching the impact or the transmission of the repo rate cut and CRR cut already given into the system. So they are watching the transmission and the impact of that very closely. This was what was stated in the monetary policy as well, in the last monetary policy. If there are threats to growth at any point of time, then RBI would cut interest rates further. That's our view. But at this point of time, there are no major threats to growth as such in existence. Next slide. As far as interest rates go, as we had indicated in the earlier slides, the rates will remain more or less range bound in the immediate term to the short term. But any threats to growth happening or to strengthen credit expansion and the cost of borrowing, then RBI could go in and cut the rates. But that's an eventuality in case of economic growth itself facing any problem. But as far as rate cuts go, there is another reason why RBI may have some reservations on further rate cuts. It's because the dollar rupee exchange rate is close to around 88.5 to 89 levels. So rupee has already cheapened up quite a bit against the US dollar, and in textbook economics, a weak domestic currency is equivalent to a cut in interest rates. So RBI may not be tempted to cut rates at this point of time with a cheaper rupee, again providing an incentive for external investors or external buyers to come in and buy from India. The interbank liquidity is aplenty now because during the advance tax payments middle of last month, there was a heavy drain of liquidity from the system. That's mainly on account of the advance tax payments. Otherwise, as of today, the interbank liquidity is close to around 1.5 to 2 lakh crores. And this liquidity is going to get enhanced further with the next two legs of the CRR cut coming into effect, which is expected to bring into the system about 2.25 lakh crores. So the interbank liquidity is good, and it is supportive of stable to lower, very short term interest rates. As far as the longer term interest rates go, that would depend on any fresh triggers. And usually a fresh trigger is something like a further cut in the repo rate and the potential or for a series of cuts that could happen in future. Going over to Brent, which is the next item, the oil prices have been quite stable. It has been around 63 to $68 per barrel has been the range in which the oil prices have been, and we expect it to remain at around these levels only unless a major flare up or a war happens in the Middle East or elsewhere. And that's not an eventuality at this point of time as we look at the various factors which are at play at this point of time. But the two factors which are actually keeping the oil prices low are the supply and demand dynamics. Does not favor higher oil prices because, as per medium to long term estimates of supply growth and demand growth, the supply growth is estimated to grow at a much higher rate than the demand growth. Demand growth may also have some other intervening factors like enhanced usage of electric vehicles and exploration of alternate energy, etc. Therefore, we expect the oil prices to remain more or less in very narrow ranges, and it could just respond to some developments, especially geopolitical developments, once in a while. Can you move on to the next slide, please? And over to Mr. Ashish Ranavade for the update on the India story in the equity markets. Thank you.
So before we get into specifically the equity markets, I think the equity markets are broadly driven by two factors. One is the fundamental factors, and second is the technical or the liquidity. Now, as far as the fundamental story of the equity markets is concerned, it's absolutely intact. In fact, at MK, we believe that the next 10 years belong to India. And some of the reasons for this optimism on India is the fact that we are a very large market. We have one of the world's largest youth population. We have a rapidly expanding middle class. All this is visible in the fact that we have more than 800 million internet users. The payment systems, the fintech revolution that we have seen or we are witnessing today, there is a booming startup ecosystem. And the best part is there is capital available for these youngsters to, go out and experiment and to develop new products and new industries. On its part, the government is doing its bit in terms of pushing for infrastructure creation. So if you see, there has been a phenomenal expansion in terms of kilometers of highways. The number of airports have gone up significantly. Metro rail has become almost ubiquitous in almost all the major metros and even the tier one cities. The emphasis on ports. In terms of renewable energy, the amount of funds which have gone into creating solar capacity and wind capacity has been amazing. At the same time, we've just had the biggest reform in GST last month. PLI has been going strong. Ease of doing business in India, the government is working on that. Make in India, all of these initiatives by the government, supported by global manufacturing giants who are moving their base to India in perhaps an effort to diversify their production bases. So we are seeing a lot of investments coming into India from overseas companies. In fact, today's newspapers carry an article of Eli Lilly, making India their hub and investing close to $1 billion in India for contract manufacturing. And I think this over the last 2-3 months, we've been seeing these kind of news coming in a big way. So all of this makes us confident that India's story is one of the best stories globally in terms of an investment potential. Next slide, Amit. Also, if you look at some of the the Asian tigers, when they took off on their growth path, we believe India is today in a similar sweet spot. So, for instance, studies have suggested that when a country reaches about between $2,000 to $5,000 per capita, the growth kicks in much faster. So this has happened in South Korea in the 70s. This happened in China in the 2000s. Also, once literacy, health, basic infrastructure, all of these cross a minimum level, then productivity and innovation can grow much faster. Also, growth accelerates when savings and investments consistently exceed 25 to 30% of GDP. And it is very well known that growth is strongest when the working population is large and dependency ratios are low. So I think all of these factors are today playing well for India, which is why I make the statement that the next 10 years actually belong to India from a very strong fundamental point of view. Next. Also, what we have seen is this is not something which we are projecting, based on, what we expect. In fact, this is also based on the fact that if you see the last 10 years, we have actually done a lot of it on the ground. So if you see the number of highways, as I mentioned earlier, in 2014, we had 91,000 kilometers. In 2024, we are at 1,45,000 kilometers. Railways was 64,000 kilometers. Today, we are at 128,000 kilometers. And it's not just the kilometers of line which has been added, the kind of trains which are seeing today. Vande Bharat is almost present across the country. And I think very soon we will have, in a couple of years, the first bullet train which will run. So it's not just the numbers, it's also the quality of infrastructure that we are creating. Tourism, travel, hospitality, that is another sector where we are doing a lot. Number of planes, we had 400 in 2014. Last year we had 713. And the largest order for airplanes has been put in by Air India and Indigo in the last 2 years, and we've seen that happen. On the back of it, air traffic has gone up from 10 crores in 2014 to 37.6 crores. The power generation capacity has gone up significantly. Renewables, which was only 30%, has now gone up to 41%. Number of villages not having electricity were 18,000 in 2014. It's zero today. So given all of these factors, given the momentum, I think you just keep this momentum intact. The next 10 years, you can imagine the kind of progress that India will make. And I think this is getting factored in, the fundamental story in India, which is also what's causing people to be more bullish on the Indian markets. Next slide. So if you see, it is the Indian investors who are seeing all of this, day in, day out, and it is them who are actually driving the markets higher. Close to 28,000 crores of SIPs coming into the Indian mutual fund industry. And it's not, as Parag mentioned earlier, it's not just the mutual fund industry is growing. There is money which is going into PMS, there is money which is going into AIFs, and there is also, from a portfolio perspective, there is a decent amount of diversification happening because a lot of Indians are now investing in American companies like Apple, Google, Amazon, because many of these companies operate in India and they derive a lot of their good part of their revenue from Indian operations. So it's an all-round development, and Indian investors are waking up to the fact that equities is one of the best performing asset classes if you take a longer term perspective. Now, all of this has caused the market to be expensive. We are today at around 21 times forward, in 22 times forward in terms of the Nifty valuations. The mid caps and the small caps are perhaps more expensive, but I think we have to realize that India today is close to 66,000 listed companies. Many of them may be in micro caps, many of them may be in nano caps or in the SME exchange. And the mid caps and the small caps represent only 400 of those. So you can see the market is much wider today. It's much deeper as well. And going forward, many companies are coming to the doing their IPOs and becoming listed, which is also taking away a good amount of the inflows which are coming into the mutual fund industry. As far as MK is concerned, we have put out a report that FY26 we expect 8% year-on-year growth in profits for the Nifty companies, and we've put out a target of 28,000 1 year forward, so which is roughly a 12% growth on the Nifty. So which kind of indicates the we may not be very heavily overweight as far as the next 12 months are concerned, but I think 12% has been in line with the long-term averages in terms of the growth as far as the markets are concerned. So overall, if you take a view, the markets continue to be in an expensive zone, but domestic investors continue to pour money into the Indian markets, which is why they continue to hold up at the current levels. But there's a lot of IPOs which are sucking out the liquidity from the market. Stock specific opportunities remain, and I think this is where some of the active fund managers who pick good stocks, high growth stocks, getting perhaps into some of the newer emerging industries, will outperform most of the fund managers, in terms of beating the benchmarks. And I think this is where investors have the opportunity to maybe stick their neck out a little and go a little aggressive in terms of 10, 15, or 20% of their portfolio and try to capture some of these opportunities. Doc, your view on gold?
And as far as gold goes, there are two factors that we need to keep in mind. One is the trajectory of US interest rates. And as far as US interest rates go, the Fed had given a 0.25% cut in the Fed funds rate in the last FOMC meeting. There is likelihood of another 50 to 75 basis points rate cut in the US. Usually, whenever the rate cut happens, the US dollar declines. And the decline in the US dollar or the depreciation in the US dollar is a strong factor which usually pushes gold and silver prices, as also other commodities prices, higher. So, with the US interest rates poised to move still lower and further rate cuts from the Fed expected over the coming 3-4 months, the likelihood of gold and silver prices holding well at the current levels and moving higher is really very good. The second thing that we need to keep in mind is that there has been quite a bit of a rise in the demand for gold from institutional investors like central banks, financial institutions, etc. Even the Reserve Bank of India had shifted out of some small amount of US Treasury bonds and Treasury securities and moved into gold. So global central banks have been buying up gold to be put as part of their reserves because it lends greater stability to the portfolio of forex reserves, as also it has a slightly better visibility than the US dollar at this juncture. Therefore, we believe that gold will continue to do well. It's close to around $4,000. In the international markets, we expect it to move higher. And gold has a very low correlation with most other asset classes, as you can see from this slide, which also makes gold an ideal component of a portfolio, maybe to the extent of 5 to 10% of the portfolio. One could take gold into the portfolio, and it's a good store of value, and it's a good hedge. These two factors and the current environment, global environment and economic environment, the interest rate environment, and the trajectory of the US dollars, all these things give much better strength to gold in the coming days. This we have already covered. Ashish, I think you are on mute.
Yeah, if I may add a bit here, silver has been trying to catch up with gold. It's been doing exceedingly well. And while gold silver ratio is something which is generally looked at by a lot of investors, I would look at the fact that the demand for silver is also driven increasingly by the photovoltaic demand, which is almost 17% of the total demand in 2025 expected, which was not there earlier. And this kind of tips the balance in favor of silver prices because there's that much gap in terms of the demand and supply. And whenever there is this kind of a favorable dynamics, we see momentum players or we see investors coming and trying to take an opportunity of that fact. And that's something which we are witnessing in silver currently. Uh, all I can say is that if Bitcoin can go from $10,000 to $121,000 in a span of 2 years, we haven't seen much in as far as silver is concerned. And from a technical point of view, also silver seems to be close to the breakout point. So maybe there is some steam left in silver, very high risk play, but from a wealth perspective, for an investor, they need all kinds of opportunities. Steady compounders, aggressive, asset classes, and also some momentum plays. So, given that, I think I would probably stick my neck out a bit and say that investors should start looking at silver ETFs. maybe maybe a very small, minuscule percentage of their portfolio. Thank you. I think we have reached the end of our presentation. If there are any questions, we're very happy
Can
to
open
take
up
them.
for Q&A. So I think there's one question already there from Suresh Iyengar. So Suresh Iyengar is from Business Line, and his question is, the current revival in demand across sectors was largely due to pent-up demand post the GST cut. Will this sustain in H2 given the job losses in IT and consistent tariff threat by US? And second question is clubbed there, that will government spending in infra continue given the possible slowdown in tax collection and falling exports? Now, the third question he's put in. Also, can you please explain about the 66,000 listed stocks and only 400 mid-cap, small-cap stocks you mean actively traded? That's the question, I think, pertaining to a figure in
I
our
think let me
presentation.
take the last part. It's not 66,000, it's 6,000 stocks. So I'm combining everything from large, mid, small, micro, the total number of stocks which are listed on all the exchanges, including the SMEs.
Right. Okay.
Doc, you want to take the first two parts of the question?
Ashish, you may continue.
Okay. So as far as the GST cut was concerned, not everybody knew that there was a cut coming, right? I mean, till about a month or 2 months back, it was not known that there is going to be a cut of this order. So if at all there was a pent-up demand, it would have been only one or two for a month or two at the most. One should not ignore the fact that, as I said, it all started in February with the budget. There was, the income tax cut which happened, which put some money into the hands of the investors. Then interest rates came down, and then the GST cut happened, and we've had a very good monsoon. So I think all of these factors one needs to look at. Also, there has been some sort of capex revival because there have been a lot of initiatives or announcements from global corporations to set up manufacturing in India along with the PLI scheme. So there has been a good amount of spending which has been happening on that front. Yes, the government spending in infrastructure has gone down, but a large part of that has shifted to defense. And as far as the impact of this government spending on the overall economy is concerned, I think it's shifted a little bit from infra to defense, but I think that's temporary. Eventually it's going to come back, and infrastructure creation is something which we are seeing. The private sector has also joined in hands with the government. So the number of airports and ports which we are seeing with participation from the private players, that's been going up. So from that perspective, I think it's not going to impact. Also, the second half of the financial year is always the best, both from a consumption perspective and infra creation perspective. So I think that is something which we should start seeing between this quarter and the next. Also, the monsoons have created a lot of problems in terms of roads getting washed out and villages getting washed out. So I think that rebuilding itself is bound to give a good boost to the economy in the Q3 and Q4 is what we feel.
Yeah. So another two questions. These are from Vivek from Reuters. Says, what do you make of the initial quarterly updates given by companies for September quarter? Do you see signs of recovery in earnings? And the second question is the market outlook in the near future, considering the rally we've seen in last few sessions is because of the IPOs that are lined up.
So we expect we've just put out Emkay's research has been put out in terms of what we expect for Q2 FY26 earnings season, yes, we expect top line growth at 2.9% year on year. PAT growth is expected at 11% year on year. So while the PAT growth is more or less in line with the year, FY26, top line growth is lower. And it's also because 57% of the companies are expected to report below par growth rate. But we are expecting second half of FY26 to benefit from, the growth should come back above par so that we maintain the overall Nifty top line growth of 8.1%. And as I mentioned, we expect roughly 8% year on year growth for the Nifty.
Okay, so I think Sharmila had raised her hand. Let me quickly help unmute her. Sharmila, you want to speak? How do we do it? You typed in your question as well. Just a moment. So, Sharmila, you can speak up.
Hi, good afternoon. Actually, I want to ask a few questions. I have also shared them on chat box as well.
Yeah, okay. You want to go ahead and ask, or do we read it out from here?
Yeah, no, I can ask as well. So,
Yeah.
my first question is related to the Indian equity markets. I want to ask which themes are likely to dominate the markets in the next 1 year. Another for the IPO market. The second question is, has India's IPO market reached its peak, considering the flurry of IPOs coming these days? So that's right. And the third question is about commodities, especially gold, silver, and platinum. As we see the price rally in gold, what percentage of portfolio investors should allocate to gold, silver, and even platinum? And the fourth question is, can we see any price correction in gold in 1 month? And if yes, by how much?
Okay, I think gold and silver, it's anybody's guess because it's largely because of. Sorry, Gaurav, you're saying something?
Please mute myself because it is very loud.
Yes, sir. You can continue. I think there was some noise in the background.
Yeah, so in terms of our research view, we are overweight on discretionary segment, discretionary spending. We are overweight on healthcare, real estate, utilities, industrials. At the same time, we are underweight on financials. We are underweight on technology, and we've just put out our reports on technology or as to why we are underweight. In terms of consumer staples, we are underweight. Telecom materials is what we are underweight on. So that's broadly the positioning as far as MK research is concerned. But as I said, active fund managers will have their own view, and as a wealth manager, it's not my job to second guess the fund managers. So we would believe that active fund managers would, as I mentioned before, outperform the broader markets. And while our broader market view is around 12% growth, there would be active fund managers who would do much better than that. So I would leave it to them to. Our job is to pick, good fund managers who've shown consistency in different kinds of markets. As far as the IPO market has reached its peak, I think it's anybody's guess as long as there is money coming in. I think the IPOs will also keep coming in. As far as gold price rally is concerned, again, it's anybody's guess. We've been recommending, 5% to 7% allocation as far as gold is concerned. But this was our recommendation 2 years back. I'm sure investors who have followed that would have seen a significant increase in, the gold purely because of gold price. Their allocations would have gone up. So from that perspective, I would say investors can continue to hold on to their gold allocation. Price correction in gold in 1 month, very difficult to answer that question. I think, the game is much bigger. The amount of money which is coming in is much bigger. So it would be very hazardous to take that guess in terms of how much it could correct by.
So, a couple of questions. So this is from Bharat Rajeshwaran. So foreign portfolio investors are on track for highest ever outflows annually from Indian markets. IT has witnessed selling given US trade uncertainties, labor market weakness, softness in spending. So since February 2021, equity MFs have been net inflows, DIs have been strong. Do you expect the trend to continue?
I think at some point in time, the foreign outflows will reverse. There will be, a point where we will start seeing foreign inflows. I think right now what's happening is they are looking at the currency. So there is the rupee depreciation has happened in the last 6 months. Also, the markets have been, from a valuation perspective, expensive. And if you take relative valuations, China was cheaper, much cheaper. From a growth valuation dynamics. So for foreign investors, it's also the relative valuation which matters. And there is, the outflows are largely probably driven by that. But I think once things settle down, eventually investors would start coming in, is what I believe.
Right. So I think to some extent, Bharat had preempted the second part of his question that small cap, mid caps have seen inflows despite valuation concerns. So particularly in context of small caps and mid caps, do you see further inflows into these segments?
See,
Considering
we are recommending investors to be more focused on large caps currently because, as I said, the small cap universe, small and mid cap universe of 400 companies is expensive. And it will take some time for the markets, or rather the fundamentals, to catch up, because yes, they are showing much higher growth than the large caps. So now corrections happen, either there could be a time correction or there could be a price correction which could make these small and mid caps attractive. So any fresh money, what we are seeing is, we are guiding investors towards large cap, at least from the short term perspective.
okay. So I think yeah. Any other questions? I see Vivek has raised his hand again. So just a moment, let me. Yeah, Vivek, you can go ahead and unmute yourself.
Yes, can you hear me? Am I audible?
Yes, Vivek, go ahead.
Yeah. So I just wanted to ask follow up to the question on market outlook. So in the near term, you were speaking about expensive valuations. So in the near term, considering the factors like IPOs that are there this quarter, we have quite a few big ones coming in, and we also have important earnings season, and in terms of commentary as well, festival season is also coming. So do you see in the near term equities outperforming other asset classes or even emerging market peers? The fact that India has been an underperformer, do you think that would change in the near term?
In the near term, I would again divide the near term into two buckets. One is pre-December and post-December. First quarter of any calendar year is generally a little weaker as far as markets are concerned. The last quarter is again, due to festival season and a lot of travel, tourism, etc. happening is generally much better. And this year, as I said, we've had a lot of positives because of the budget, GST, interest rates, etc. Also, there's been a pent-up demand. So that may kind of create a short-term momentum as far as markets are concerned. But if you take a slightly longer term perspective or a 1 year perspective, then as I said, we're not expecting the markets to do anything exceptional. Um, some 10 to 12% growth is what we can expect on the Nifty, is what we are saying.
Okay. Thank you.
That's perfect. Any other questions? So I guess, like the airports, they say last call for any questions. Else, you may reach out to our media agency, Whitemark Solutions, or you may reach out to us on media@emkayglobal.com if you have any questions at a later point in time. I guess there are no more questions. Thank you. Thank you so much, friends, for being with us. Thank you, Parag sir. Thank you, Ashish sir. Thank you, Dr. Joseph Thomas, for
Thank
being
you.
with us.
Thank you.
Thank you for your valuable time, guidance. Thank you so much.
Thank you.